The video feed from Tehran's Grand Bazaar flickered once, then cut to black. It was 11:47 p.m. on January 8, 2026. Within minutes, every internet connection in Iran, from the fastest fiber optic lines in North Tehran to the slowest dial-up connections in rural Kurdistan, went silent. The digital blackout was total, unprecedented in its scope, and deliberate in its timing. What the world didn't know yet was that this wasn't just another protest crackdown. It was the beginning of a financial exodus that would send shockwaves through global precious metals markets and redefine the meaning of safe haven assets in the 21st century. 3 hours before the blackout, Reza Mohammadi, a gold trader in Tehran's historic jewelry district, received a phone call that changed everything. The voice on the other end spoke in rapid Persian, each word laden with urgency. "Convert everything to silver. Now. Don't ask questions." The caller hung up before Mohammadi could respond. Similar calls were being made across Iran's financial networks, from the money changers in Isfahan to the commodity traders in Shiraz. Something fundamental was shifting in the Islamic Republic, and those with connections knew that paper assets were about to become worthless. The protests that began on December the 28th, 2025 started like many before them. The rial had collapsed to 1.42 million against the dollar. Food prices had increased 72% year over year. Water shortages plagued major cities. Electricity cuts lasted up to 16 hours daily. But this time, something was different. The shopkeepers who closed their shutters in protest weren't just the usual suspects from the bazaar. They included the conservative merchants who had supported the regime for decades. The students marching weren't just from liberal universities, but from religious seminaries in Qom. The demographic firewall that had protected the Islamic Republic for 47 years was crumbling. By the time authorities ordered the internet shutdown on January 8th, Iran International was reporting 2,000 deaths in 48 hours. Hospitals in Tehran and Shiraz overflowed with gunshot victims. The Islamic Revolutionary Guard Corps had declared the period of tolerance over, but beneath the violence, a more subtle transformation was underway, one measured not in street battles, but in ounces of precious metal. The flight to silver began quietly, almost imperceptibly, in the final days of 2025. Iran's wealthy elite, sensing the regime's vulnerability, started liquidating assets. Real estate, difficult to sell quickly in a collapsing economy, was abandoned. Stock portfolios, already decimated by sanctions and mismanagement, were dumped at any price. Even gold, traditionally the ultimate store of value in Persian culture, was being exchanged for its less glamorous cousin. The reason was simple. Silver was easier to transport, harder to track, and critically had industrial applications that made it valuable anywhere in the world. This wasn't mere speculation or panic buying. It was a calculated bet on regime collapse by those who understood the mechanics of state failure better than anyone, the insider class that had profited from the Islamic Republic for decades. Former government ministers, IRGC commanders' families, and sanctions-busting businessmen were quietly moving their wealth into forms that could survive a government collapse and potential international manhunts. Silver, with its dual nature as both money and industrial commodity, offered unique advantages. Unlike gold, which screamed wealth preservation, silver could be explained as inventory for electronics manufacturing or solar panel production. The Mohammadi family's jewelry shop became a microcosm of this transformation. In normal times, they might see 5 or 6 significant silver transactions per week. By January 6th, they were processing that many per hour. Customers arrived with suitcases of rials, desperate to convert depreciating paper into tangible metal. Some brought gold jewelry passed down through generations, willing to trade family heirlooms for more portable silver coins and bars. The most telling sign? Government officials' wives, recognizable despite their attempts at discretion, exchanging massive gold sets for discreet silver packages. But the real action wasn't happening in public shops. In North Tehran's affluent neighborhoods, private dealers operated from fortified compounds, facilitating transactions that would have been impossible through official channels. Here, the Islamic Republic's elite were converting millions of dollars worth of assets into silver, using networks originally designed for sanctions evasion. The irony wasn't lost on observers. The very systems created to circumvent international restrictions were now being used to escape the regime itself. The economic mathematics driving this exodus were stark. Iran's currency had lost 90% of its value since 2018. Inflation, officially at 42%, was closer to 60% in reality. The government's foreign exchange reserves, already depleted by sanctions and corruption, couldn't defend the rial, even if authorities wanted to. But it was the proposed 2026 budget that truly signaled the end. President Pezeshkian's plan increased security spending by 150%, while offering wage increases that covered less than half the inflation rate. The message was clear. The regime was preparing for war against its own people, not economic recovery. International precious metals markets began registering anomalies by January 5th. Silver withdrawals from the Shanghai Gold Exchange spiked 300% above normal. Turkish dealers reported unprecedented demand from Iranian buyers. Dubai's gold souk, long a hub for Iranian transactions, saw silver premiums reach 20% above spot price, unheard of in normal market conditions. But these were not normal conditions. This was the physical manifestation of a society losing faith in its governing institutions. Yet the surge in the silver demand from Iran represented more than just wealth preservation. It was a vote of no confidence in the post-revolutionary order itself. Every rial converted to silver was a bet that the Islamic Republic's days were numbered. Every transaction conducted in darkness, away from official scrutiny, was an acknowledgement that the social contract between ruler and ruled had irreparably broken. The security apparatus understood this dynamic, which explained their increasingly desperate measures. On January 7th, authorities announced new restrictions on precious metals trading. Banks were ordered to report all significant withdrawals. Border guards received orders to search for hidden silver shipments. But these measures only accelerated the panic. Like capital controls throughout history, they confirmed fears rather than calming them. The rush to convert paper wealth to physical silver intensified. Meanwhile, in the streets, the uprising continued to spread. What started in Tehran's Grand Bazaar had reached all 31 provinces. Kurdish areas in the northwest, long marginalized and persecuted, erupted in coordinated protests. Balochistan in the southeast, home to another oppressed minority, saw entire cities slip from government control. Even in the regime's heartland, cities like Qom and Mashhad witnessed unprecedented demonstrations. The security forces, stretched thin and demoralized, resorted to increasingly brutal tactics. But each massacre only fueled more resistance. The human cost was staggering. By January 10th, human rights organizations estimated over 2,500 deaths, though the true figure was likely higher given the information blackout. Mass arrests filled prisons beyond capacity. Reports emerged of authorities using schools and sports complexes as makeshift detention centers. But perhaps most telling were the defections. Videos smuggled out despite the internet shutdown showed security forces laying down their weapons, some even joining protesters. The monopoly of violence, that ultimate foundation of state power, was cracking. This breakdown in authority accelerated the flight to silver, as city after city witnessed running battles between protesters. And security forces, the wealthy weren't the only ones seeking to preserve wealth. Middle-class families pooled resources to buy silver coins. Small business owners converted inventory to precious metals. Even government employees, paid in increasingly worthless rials, sought any means to protect their savings. The national currency was experiencing a crisis of confidence that went beyond exchange rates. It was losing its fundamental function as a store of value. The regional implications were immediate and profound. Saudi Arabia, watching its Shia rival convulse, quietly increased security around its own Shia-majority eastern province. The UAE, home to hundreds of thousands of Iranian expatriates, saw massive capital inflows as Iranians transferred wealth to Dubai's banks and gold dealers. Turkey, balancing its complex relationship with Iran, became a crucial conduit for both refugees and capital flight. Each neighboring country faced its own calculations about containing spillover effects while potentially benefiting from Iran's chaos. But it was the impact on global silver markets that truly demonstrated the uprising's international significance. London dealers reported their lowest inventory levels in decades. Comex warehouses in New York saw daily withdrawals that dwarfed deposits. Industrial users, from solar panel manufacturers to electronics companies, found themselves competing with safe haven demand for limited supplies. The price, already elevated by years of industrial consumption exceeding mining supply, began a parabolic rise that would redefine precious metals markets. The feedback loop between Iran's political crisis and silver prices created its own dynamic. As protests intensified, silver demand increased. As silver prices rose, more Iranians sought to convert wealth before their currency collapsed further. This self-reinforcing cycle drew in speculators and momentum traders, amplifying moves in both directions. Technical analysts noted that silver had broken through resistance levels that had held for years, entering what they called price discovery mode. Traders speak for uncharted territory. Central banks, traditionally focused on gold, began paying attention to silver's monetary resurgence. The People's Bank of China, already holding massive gold reserves, quietly instructed state entities to accumulate silver. The Reserve Bank of India, watching nervously as Iran's crisis threatened regional stability, accelerated its own precious metals purchases. Even European central banks, dealing with their own energy crisis, exacerbated by Middle Eastern instability, began reassessing silver's role in monetary reserves. The metal that had been demonetized in the 20th century was reclaiming its monetary function in the 21st. The Iranian government's response to capital flight only made matters worse. On January 11th, Supreme Leader Khamenei gave a speech blaming economic terrorists for currency instability. The Revolutionary Guards announced a crackdown on illegal currency trading. But these measures revealed the regime's fundamental misunderstanding. This wasn't currency speculation. It was a society preparing for state collapse. Every family converting savings to silver was making a rational decision based on historical precedent. They had seen what happened in Lebanon when the banking system collapsed, in Venezuela when hyperinflation destroyed the bolivar, in Afghanistan when the government fell. Silver offered protection against all these scenarios. As the uprising entered its third week, patterns emerged that suggested this was different from previous protests. The 2009 Green Movement had been largely urban and middle class. The 2017-2018 protests were working class but localized. The 2019 fuel protests were intense but brief. The 2022 Woman Life Freedom Movement was inspirational but ultimately contained. This time, every segment of society was involved. More critically, the economic dimension, manifested in the flight to silver, meant that even regime supporters were hedging their bets. International responses varied but shared common concerns. The Biden administration, in its final days, issued statements supporting protesters' rights while avoiding commitments. President Trump, preparing to return to office, promised unspecified actions if violence continued. European leaders, dependent on Middle Eastern energy, called for dialogue while preparing for refugee flows. But perhaps most significant were the silent preparations: military assets moving to the region, intelligence agencies gaming out scenarios, and financial institutions stress-testing their exposure to regional instability. Yet, for all the international attention, the real story remained intensely local and personal. In apartment buildings across Tehran, neighbors shared generators and internet workarounds. In Shiraz, doctors treated wounded protesters in secret clinics. In Isfahan, merchants organized distribution networks to bypass government controls. This grassroots organization, built through previous waves of protest, proved more resilient than authorities anticipated. Each neighborhood committee, each underground network, each informal support system represented a parallel structure that could survive state collapse. The silver market became a barometer of this societal transformation. Premiums in Tehran's black market reached 50% above international spot prices. Smuggling routes, once used for sanctions busting, now carried silver out and hard currency in. Turkish border towns saw a thriving trade in precious metals. Armenian dealers facilitated transactions for the desperate. Even cryptocurrency, despite internet restrictions, played a role as tech-savvy Iranians used mesh networks and satellite connections to move wealth digitally before converting to physical silver. By mid-January, the uprising had evolved from protests to something approaching revolution. The regime retained control of security forces and state media, but its authority extended only as far as its guns could reach. Civil administration in many areas had effectively ceased. Courts no longer functioned. Tax collection stopped. Even basic services like garbage collection and postal delivery became sporadic. In this vacuum, alternative structures emerged. Neighborhood committees organized security. Merchants created their own arbitration systems. Traditional social networks, suppressed for decades, reasserted themselves. And the economic implications went beyond currency collapse and capital flight. Iran's oil production, already reduced by sanctions, fell further as workers joined strikes. The Abadan refinery, symbol of Iran's petroleum industry, operated at 30% capacity. Export terminals reported technical difficulties that prevented loadings. Even the IRGC's smuggling networks, crucial for evading sanctions, faced disruption, as their own personnel questioned the regime's viability. The economy wasn't just struggling, it was disintegrating. This disintegration accelerated silver demand in unexpected ways. Industrial facilities, fearing nationalization or destruction, converted inventory to precious metals. Universities liquidated endowments. Religious foundations, controlling vast wealth, quietly diversified holdings. Even government pension funds, in a stunning admission of reality, began allocating to precious metals. The entire society was effectively shorting its own currency and political system. The human dimension of this transformation defied easy categorization. Elderly bazaars who had survived the revolution, the Iran-Iraq War, and decades of sanctions spoke of unprecedented fear. Young protesters, born after the revolution, expressed unprecedented hope. The middle generation, caught between nostalgia and aspiration, made practical preparations for an uncertain future. All shared one common action: converting whatever wealth they could into forms that might survive the transition ahead. International precious metals analysts struggled to model the situation. Traditional supply-demand frameworks couldn't account for societal collapse driving monetary demand. Technical analysis failed when political events created discontinuous price movements. Even fundamental analysis, focused on industrial usage and mining supply, missed the bigger picture. Silver was becoming a form of stateless money for a society losing faith in states themselves. This wasn't just another commodity bull market. It was a monetary phenomenon with few historical precedents. The spillover effects reached far beyond Iran's borders. Turkish silver imports reached record levels as dealers facilitated Iranian demand. Indian premiums spiked as regional instability drove safe haven buying. Chinese industrial users faced competition from monetary demand. European solar panel manufacturers warned of production constraints. The global silver market, already tight from years of deficit, couldn't easily accommodate an entire nation converting its wealth to physical metal. As January progressed, the feedback loops intensified. Each day of protests increased regime fragility. Each sign of weakness accelerated capital flight. Each spike in silver demand raised prices. Each price increase validated the decision to convert early. This self-reinforcing dynamic created what systems theorists call a phase transition, a rapid shift from one stable state to another. Iran wasn't experiencing mere political unrest or economic difficulty. It was undergoing fundamental transformation. The regime's remaining supporters faced an impossible choice: stay loyal and risk losing everything in a collapse, or hedge their bets and contribute to the very instability they feared. Most chose a middle path, public loyalty combined with private preparation. Revolutionary Guards commanders maintained fierce rhetoric while their families moved assets abroad. Government ministers attended cabinet meetings while their wealth managers converted portfolios to precious metals. Even clerics, ostensibly focused on spiritual matters, ensured their foundations held physical silver. This dynamic created surreal contradictions. State television broadcast propaganda about economic resilience, while its own employees queued at gold shops. Officials gave speeches denouncing economic terrorism, while their wives sold jewelry for silver coins. The cognitive dissonance became unsustainable. Everyone knew everyone else was preparing for regime change, but nobody could acknowledge it publicly. The emperor had no clothes, and the entire court was discreetly packing their bags. International efforts to mediate faced fundamental obstacles. The protesters' demands, regime change, not reform, left little room for compromise. The government's response, escalating violence, eliminated trust necessary for dialogue. External powers pursued contradictory agendas. America wanted regime change. Russia sought stability. China desired continued oil flows. And Europe feared refugee waves. In this diplomatic paralysis, ordinary Iranians made their own arrangements, one silver transaction at a time. The monetary implications extended beyond Iran. If a G20 economy could see its currency collapse and citizens flee to precious metals, what did that mean for global financial stability? Central banks quietly increased allocation studies. Sovereign wealth funds reviewed commodity exposures. High net worth individuals globally added physical precious metals to portfolios. The Iranian example suggested that in an interconnected but unstable world, traditional safe havens might not be safe enough. As the uprising entered its fourth week, exhaustion began setting in on all sides. Security forces, despite regime loyalty, couldn't maintain indefinite violence. Protesters, despite determination, faced the grinding reality of economic collapse. The international community, despite concern, lacked good options for intervention. In this stalemate, silver served as both barometer and safety valve, measuring regime weakness while providing citizens an escape route for wealth preservation. The historical parallels were imperfect but instructive. The French Revolution saw similar monetary chaos, with assignats collapsing and citizens hoarding metal. The Russian Revolution witnessed comparable capital flight, though geographic isolation limited options. The fall of the Shah included economic disruption, but oil wealth cushioned the transition. This time, sanctions had eliminated cushions, geography facilitated capital flight, and modern communications enabled coordination despite repression. The result was a society-wide bet against its own institutions, denominated in silver. Market technicians noted that silver's price action showed classic signs of a paradigm shift. The metal wasn't just rising, it was re-rating. The gold-silver ratio, historically ranging between 41 and 80:1, compressed toward 20. 1. Options markets priced in not just volatility, but fundamental uncertainty about future price ranges. Forward curves inverted, suggesting immediate supply constraints. These technical indicators confirmed what events in Iran suggested. Silver was transitioning from commodity to currency. Yet for all the market analysis and geopolitical speculation, the human reality remained paramount. Each silver coin represented a family's savings, accumulated through years of work despite sanctions and inflation. Each bar smuggled across borders carried someone's hopes for a different future. Each transaction in Tehran's underground markets was an act of faith, not in any government or system, but in precious metal's ability to preserve value across whatever transition lay ahead. The regime's final attempts to maintain control only accelerated its demise. Currency controls made legal business impossible, driving all economic activity underground. Violence against protesters created martyrs and strengthened resistance. Internet shutdowns prevented coordination, but also blocked regime propaganda. Each repressive measure backfired, creating the very instability authorities sought to prevent. The Islamic Republic was defeating itself. As January drew to a close, the inflection point approached. Either the regime would find some way to stabilize, through compromise, repression, or external support, or Iran would experience the first collapse of a major oil-producing state in the social media era. The implications, either way, were profound. Success in preserving wealth through silver would validate precious metals as ultimate safe havens. Failure would question all assumptions about portfolio protection. The stakes couldn't be higher. The global financial system watched nervously. Iran's integration into world markets, despite sanctions, meant that collapse would have unpredictable ripple effects. Energy markets faced disruption. Regional banks faced losses. International companies faced asset seizures. But most concerning was the precedent. If Iranians could successfully preserve wealth through physical precious metals during state collapse, what would stop citizens elsewhere from making similar preparations? The demonstration effect threatened comfortable assumptions about financial stability. In this context, silver wasn't just an investment or trade. It was a vote on the future of money itself. Every Iranian family converting rials to silver was rejecting not just their national currency, but the entire framework of state-controlled money. They were betting that, in extremis, only physical metal, not paper promises, digital entries, or government guarantees, would retain value. This bet, multiplied across millions of people, created its own reality. The outcome remained uncertain as February 2026 approached. The uprising might succeed, ushering in a new government that honored property rights and stabilized the currency. It might fail, leading to crushing repression and economic isolation. It might result in civil war, fragmenting Iran along ethnic and religious lines. Or it might produce something unprecedented, a gradual dissolution of central authority with local alternatives emerging organically. In all scenarios, except swift regime victory, silver would likely preserve wealth better than any alternative available to ordinary Iranians. This fundamental uncertainty drove continued demand. Even as prices reached levels that would normally trigger profit-taking, physical offtake remained strong. Paper silver markets in London and New York saw volatile trading, but physical markets from Istanbul to Dubai reported consistent buying. The disconnect between paper and physical prices widened, suggesting that real demand was overwhelming financial speculation. This wasn't a bubble driven by sentiment, it was a repricing driven by reality. The broader implications for precious metals were transforming traditional investment frameworks. Portfolio theory assumed government bonds as risk-free assets. Currency analysis presumed stable nation-states. Commodity models focused on industrial supply and demand. But Iran's example suggested these assumptions might be obsolete. In a world of failing states, weaponized currencies, and social media-coordinated uprisings, only physical assets might provide true safety. Silver, straddling the line between money and commodity, emerged as the unexpected beneficiary of this paradigm shift. As the world watched Iran convulse, other societies took note. In Lebanon, where banking collapse had already destroyed savings, silver imports spiked. In Turkey, facing its own currency crisis, citizens increased precious metals purchases. In Argentina, perpetually battling inflation, silver premiums rose. Even in stable democracies, a subtle shift occurred. The conversation changed from whether to own precious metals to how much. Iran's uprising had become a global teaching moment about the fragility of monetary systems, yet the ultimate lesson transcended finance. The Iranian people's flight to silver represented more than wealth preservation. It was an assertion of autonomy against authoritarianism, a declaration of independence from institutional failure, a bet on their own judgment over official pronouncements. In choosing honest money over political money, they were voting for values that transcended any particular regime. This moral dimension, often lost in market analysis, explained the movement's power. The story continued to unfold, written in demonstrations and bullion flows, and casualty figures and price charts. But certain truths had already emerged. Trust, once broken, couldn't be easily restored. Currencies, once debased, faced replacement. Regimes, once delegitimized, struggled to govern. And silver, once dismissed as obsolete money, reclaimed its historical role when modern alternatives failed. These lessons, learned at tremendous human cost in Iran's streets, would reshape global understanding of money, power, and the precious metals that outlasted both. The immediate future remained shrouded in internet blackouts and information warfare, but the medium-term trajectory seemed clearer. Whether the Islamic Republic survived or fell, Iran's economy faced years of difficulty. Recovery would require not just political change, but rebuilding trust in institutions. Until then, silver would continue serving its ancient function, preserving wealth when nothing else could be trusted. In Tehran's bazaars and Dubai's vaults, in Turkish border towns and European refineries, the metal that built Persian empires was helping ordinary Iranians navigate their empire's potential end. The global repricing of silver had only begun. What started as Iran's local crisis was becoming the world's monetary revelation. In an age of infinite money printing and digital experiments, the uprising reminded everyone that when society itself hung in the balance, only physical reality, not political promises, retained value. This truth, denominated in troy ounces rather than rials or dollars, might prove the most lasting legacy of Iran's winter of discontent.